We have developed something in America, frankly, America, and I'm going to say America, that has allowed us to invest, participate in the capital markets, grow our wealth through all of these nuanced systems, and allow all of us to participate in building wealth, which couldn't have been done 100, 200 years ago. Many of us would have stayed as serfs or peasants, and here we are able to participate in these capital markets. It's these indicators, it's these economic insights that allow that to happen with transparency, and for that, I'm appreciative. We just have to put in the right context. Hey, this is Darryl Lyons, CEO and co-founder of Pax Financial Group, and you're listening to Pivot with Darryl Lyons. Remember, this information is general in nature only. It's not intended to provide specific investment, tax, or legal advice. Visit paxfinancialgroup.com for more information. And I want this to be the beginning of a conversation because it's my conviction that really smart money decisions, the best money decisions, do happen in a conversation. I know ChatGPT helps a lot, helps me in a lot of areas of life, but at the end of the day, there's something to be said just about wrestling with these thoughts in a human format. Okay, so I really want to help you learn to react to economic readings in the economy. You probably don't care until you do. And here's what happens. It's crazy because these headlines leverage clickbait, and they cause you to have a little bit of a panic. And they usually use some half-truths to be able to do this. And so I'm trying to get you in front of this. So they might talk about CPI or personal consumption index or employment reports or initial employment claims, and then they'll use phrases and they will pop up as a headline, whatever news outlet you're looking, and it will follow up with phrases. And I've seen these phrases these words over and over again. They will say something about these economic indicators crashed or dropped dramatically, or spiked, or some dramatic word will be associated with it. And it's clickbait, but it's important for you to understand because they're connecting a truth to an emotion. And then, of course, we react. And so I want to just train you a little bit to recognize these economic indicators and how they work so you'll be able to understand how to respond to them. And I want you to follow the breadcrumbs a little bit. So I'm going to help you kind of navigate this economic thought process that occurs when people evaluate these indicators to make investment decisions, because they are useful indicators when used in a rational, unemotional way. Let's follow the breadcrumbs. Do you remember Hansel and Gretel? So I'll remind you of the story if you don't remember. It's a European story, an old European fairy tale. And it's kind of a sad story, frankly, because the stepmother, there's always an evil stepmother, and this poor carpenter dad didn't have money, and they were broke. And if they kept their two kids, they were all going to starve. So the solution was, the stepmother's solution was, we will drop our kids, these two kids, off in the middle of a forest, and they can fend for themselves. And so the boy, I think it was the little boy that heard about this little story or this plan of evil stepmom, and said, I'm going to go ahead and take the bread that she gave me, because they gave them just enough bread and a little fire to survive. I'm going to take the bread and I'm going to drop the bread on the way as she takes us from the house to the forest. And I'm going to, when they leave and go back to the house, I'm going to follow the breadcrumbs back to the house so I can go home. So that's the story. And as you know, they stay in the forest and come across a witch. Okay, so the breadcrumbs, that's what we say, follow the breadcrumbs to back to the source, back to the information, back to something that we're going to follow the breadcrumbs back. I want to continue playing on this fairy tale because I think it has an additional application as you continue to think about how horrible it is as an adult listening to it. But consultants also use the same theme behind breadcrumbs in a process called the 5 whys. And you've heard me say the 5 whys before. So let's use this in an economic context. Why did the stock market go up today? Somebody might ask me that. They've asked me that 1,000 times. Why did the stock market go up today? And I might say, well, the Federal Reserve, lowered interest rates. the next why question. So that's why number one. Why number two? Well, why did the Federal Reserve lower interest rates? The answer: to grow and stimulate the economy. Well, why do they want to? And this is a good question, so it's not a stupid question. Well, why did they find that right now it was appropriate to grow and stimulate the economy? Well, because they had reason to believe that the economy was getting weak. Next why is, why was it getting weak? Because people were afraid to buy things, to start businesses, to buy houses. And again, here's the last why. Well, why are people so afraid of buying things? They're afraid because they're not confident that tomorrow will be better than today. And that takes us on this breadcrumb journey to these economic indicators, that there's some information that came out that leads us to believe that people aren't confident. Let me give you an example. This is the one I've followed for a number of years. It's a helpful economic indicator. In and of itself, it's not the end-all be-all, but it's a good one. It's the Michigan Consumer Sentiment Survey that's done. It's done monthly. It's done with just, I think it's 1,000 households, maybe 600 now that I think about it. You can look that up. And it asked these households how they feel about their personal finances, about the current business condition, about the climate. It asked them whether or not they're going to make some purchases in the near future. And it's been a pretty good index to get a pulse on whether or not people are confident about tomorrow. Now, without a doubt, and economists know this, there's a degree of political overlay here. So if they don't like the current administration, or if there's a war going on, that impacts the optimism. But it has historically given us a good pulse of whether or not people are confident about tomorrow. I'll even give you an example of what's going on today. So it makes this podcast less evergreen, but July 2026, so if you're listening to this in the future, it may not apply. They did this sentiment, and the final numbers came out, and the index rose from 49.5 in June, and then they look at it in July, it was 55.2. So typically above 50 has been pretty confident. Like, everyone's feeling pretty good. They're feeling good about tomorrow. They're going to go and buy some stuff. And so they look at that, and that's actually, it doesn't seem like a big number, but that's actually an 11.5% increase. So pretty good. Now, they start to get preliminary readings. I actually don't know how they get preliminary readings. I could probably look that up, and you could too. But the reading fell from 55 so far. And so going into August, from 55 to 51. So that's a 7.6% monthly decline. So in 1 month, just 1 month, people are starting to feel a little less optimistic. So that indicator may come out in the morning. And by the way, people try to front run this indicator and try to make stock trades even before it comes out. They try to get wins. So Michigan Survey Index sits really tightly. I was at a restaurant with somebody who had the indicator in advance, and she was like, I know it, but I can't tell it to you. And it was fun to know that I was really in close proximity to somebody who had a lot of inside information that I could potentially trade on, that I didn't want to do it. I didn't want to break the law, but it was fun to know I was right there. And it's that much power. These indicators have that much power because people will trade on it. The market will react to these things. The stock market will move in one way or another. Why? Because, again, we're going to reverse engineer this breadcrumb. So you can do it either way, these breadcrumbs, and say, well, if this indicator dropped, people are less confident. They're not going to buy as much. If they don't buy as much, then businesses aren't going to grow and houses aren't going to be purchased. And if that happens, then, of course, the companies that manufacture houses or products and services or need the capital to invest, the prices of those stocks will go down because people are less confident overall in the markets going forward. So these breadcrumbs are really important. Now, individually, they're almost meaningless. Sometimes I would say I've seen sometimes where there's a really big reaction towards them, maybe because, namely, and this is oftentimes the case, the Federal Reserve might be putting a lot of weight into one, or the market feels like there's a lot of weight into one. And so sometimes these indicators will have some really profound impact on the stock market's outcome. And other times it's just benign. Sometimes it's just a passing and fleeting indicator. I think it's all in context of what else is going on in the economy. But it's one to know because, as I said in the beginning, it's really easy for CNBC, Fox News, CNN, any of them to give you a headline. You're pulling up your Facebook or whatever, and it pops up and says, the Michigan consumer sentiment crashes. And you think, oh my gosh, what is going on? And then you get nervous. And a crash, honestly, they might say crash and it might have fallen by 10%. And they might even use 10%, and that might scare you. But it's one breadcrumb. And sometimes it's meaningful and sometimes it's meaningless. The interesting thing about the parable, not the parable, I don't want to make it sound like it's a Jesus parable, the fable, the fairy tale, is the interesting thing about it, and you may or may not remember, is that the breadcrumbs didn't work for Hansel and Gretel. They actually didn't work at all because birds came along and ate them. What worked for them were stones. So initially, when the stepmom dropped them off in the forest, the kids actually had little stones that they set down between the house and the forest. And the intent was that the moonlight would shine on the stones and give them a pathway back home. But when they went back home, because they followed these stones, the stepmother thought, well, you guys, you outwitted me this time, but I'm going to drop you off and I'm going to make sure you don't have any stones. But the kids did have bread. So the bread was their second iteration, but it was the stones, the little stones that were able to guide their way back. So sometimes, I say all that because I'm making the parallel here between the fairy tale and the market. Sometimes these indicators are stones. Sometimes they work. Sometimes they do draw conclusions for you that are very relevant. And sometimes they're just simply breadcrumbs that really don't matter. I guess you could say that we're just simply eaten by birds. So it's hard to say when these indicators are important. I think in the context of the market and your portfolio, collectively, they can tell some pretty interesting stories. And oftentimes I'll look at them as a whole, as one maybe piece of evidence. But please, whatever you do as we go forward, right now the market has been doing very well for many of us. We've seen our portfolios go up. But oftentimes in this podcast, I want to train all of us, frankly, to get in front of our future selves. The market will go down and it will go up. It's just a part of life. And I think it's incumbent upon us to be mature enough to recognize, hey, when these things happen and when I start to see more and more headlines, that I just take a deep breath. I recognize sometimes it's a breadcrumb, sometimes it's a stone. It's a good idea just to reach out to your advisor and say, hey, how much weight should I put in this? What else are you seeing? Of course, advisors aren't economists, nor am I, frankly. But I think collectively we will work together to try to find out if these are legitimate concerns that we should have and maybe reposition portfolios. Oftentimes it's a do-nothing kind of situation. In fact, most of the time it's a do-nothing situation. But these economic indicators are interesting to me as a nerd in this space. And I think they're interesting as a whole. I think it does these collective breadcrumbs and stones, depending on the situation, it determines whether or not they're useful or not. But I think collectively it does make a case that this market, this capital market, has a whole plethora of indicators that are very efficient, that give us a lot of information about the pulse of the economy. And I find that to be fascinating, and one that I think is often understated, how sophisticated and well established, still subject to some challenges, our whole economic system and capital markets are. It is understated that we have developed something in America, frankly America, and I'm going to say in America, that has allowed us to invest, participate in the capital markets, grow our wealth through all of these nuanced systems, and be able to allow all of us to participate in building wealth, which couldn't have been done 100, 200 years ago. Many of us would have stayed as serfs or peasants, and here we are able to participate in these capital markets. It's these indicators, it's these economic insights that allow that to happen with transparency. And for that, I'm appreciative. We just have to put in the right context. I hope that helps today to get in front of your future self, to recognize how these economic indicators can or may impact your portfolio and how you should react to them going forward. Hey, this is Darryl Lyons. Thanks for listening today. And remember, you think different when you think long-term. Have a great day.